Here is a financial concern expressed by pre-retirees and retirees in discussion forums and groups. I bought my variable annuity because someone told me it was a safe way to grow my retirement money. But now I'm reading that if the market drops, my actual account value drops too. Does that mean I could actually lose money in what I thought was a retirement safe product? Nobody explained that to me. By the end of this video, you will exactly understand how variable annuities expose your principal amount to market losses and why most people don't find it out in time. I'll also show you one specific feature within a fixed indexed annuity which will entirely remove this risk from your retirement. I am Sridhar, a financial advisor in the retirement wealth management space. Over the years, I've helped several pre-retirees and retirees secure finances for the retirement years. I will provide a strategic solution for a very specific financial problem within every video under 5 minutes. Now, in this video, we're going to discuss how variable annuities expose your principal to market losses and why it's late for people to realize that. And also, I'll show you one feature within fixed indexed annuities which will remove this risk permanently from your retirement. Now, what is the main problem? Variable annuities do drop in value if there's a market correction. Most retirees, or at least some retirees, do not realize that. Secondly, the fee associated with a variable annuity is high, usually 2 to 3%, sometimes even more than 3%. And most owners don't find out that they check that they have lost money because of market corrections until they see their quarterly statement. And if you have already initiated your variable annuity, it's not easy to get out because there's a surrender fee associated with it. Now, what are the current approaches that most people do and why do they fail? First, they want to spread the money within this variable annuity, which means they will invest it in bonds and stocks. That's a good strategy because it reduces the single fund risk. But however, if there's a market correction, if the entire market drops, then the funds within your accounts in your variable annuity will also drop. There's no way to stop it. Secondly, most people think that annuities are safe. Annuities are safe depending on the kind of product that you choose, not variable annuities because they're invested in the market. So you have to choose the right annuity. For example, fixed indexed annuities are actually not exposed to the market. Variable annuities are securities, so you will lose funds if the market there's a market correction. Third, they see the rising balance within their variable annuity, assuming that the funds are growing when the market is doing well, which is actually true. But then they actually have to look into the fee that's associated with their sub-accounts within that variable annuity. Now, what is the solution that I propose? I propose a 0-4 principal lock, a feature that's built into a fixed indexed annuity. What is this? If there's a market correction, if the market drops by 10, 20 or 30%, your funds within your fixed indexed annuity will not drop at all. The only thing is that your funds in that account will not grow in that given year. Second, protection is actually built into that fixed indexed annuity, which is one of the main features of a fixed indexed annuity. And then you grow from that protected base next year. So this year there's a market correction. So the funds did not grow within your fixed indexed annuity. But next year, when the market recovers, you grow from there. So there's no loss, but you actually stall for a brief period and then you grow back again. Now, let's look into the steps to know where you stand with your variable annuity and what you need to do. First, you want to call your insurance carrier. You want to tell them that this is your contract number and you write an email to them asking them for a full fee disclosure. This way, you will understand what are all the administrative fees, mortalities and expenses. And you'll also see what are the sub-account fees and everything. So once you have that, you'll also see how many years is left within your variable annuity before you can actually roll over the funds from this variable annuity into a different product. Let's say you initiated your variable annuity a year or 2 years or 3 years ago, then I would not worry about surrendering it because then you have to pay a huge surrender fee to get out of the variable annuity. Let's say, for example, you initiated your variable annuity this year and you want to exit right now, you probably have to pay 10% or more in surrender fee. So ideally, let's say you have $300,000 in your retirement accounts with your variable annuity. And if you want to exit in the first year, you pay more than $30,000 in surrender fee, which is not a good option at all. On the contrary, let's say you're in your 7th or 8th year, if you're nearing the 10-year period, probably it's a good idea to exit the variable annuity because your surrender fee is then about 3% or so. You're paying 3% fee anyway for the variable annuity in every year. So you might want to pay that as a surrender fee and exit from that variable annuity. Now, just let me say one thing important here before I go to step number 3. Variable annuities as such are not bad products. But the thing is, if you're nearing retirement or if you're already in retirement, this is not a product that I would recommend you because the money is invested in the market and you don't want to take all these risks just before retirement or if you're already in retirement. Okay. Now, point number 3, I would compare my variable annuity growth with a fixed indexed annuity. What I'm saying is, look at the net returns after all costs. I don't want you to look at the gross market performance of variable annuity, because if you look at the gross market performance, variable annuity looks much better than a fixed index annuity, but you want to deduct all the fees and everything and then look at it. Now, if you think it's right that you want to move your funds from variable annuity to fixed index annuity, then you perform something called a 1035 exchange. 1035 is an IRS tax code which allows you to roll over funds from a variable annuity to a fixed index annuity. Remember, your 401k accounts, your variable annuities, and your fixed index annuities, all these are retirement accounts. So you're rolling over funds from one retirement account to the other retirement account. And if you do this 1035 exchange, it does not incur a taxable event. Fifth, you want to confirm the zero floor within this fixed indexed annuity. Don't just look at the brochure, look at the contract itself. Usually, if it's a fixed indexed annuity, then it does have a zero floor, which means if the market drops, your funds do not drop. This is the one important feature that I was speaking about in the beginning of this presentation. Now, why does this strategy work better? Understand this. The 0-4 principal lock, what it does is it protects your funds. If the market drops by 30%, your funds do not drop at all. Okay. And you always grow from that protected floor the next year. And when you want to take retirement income from it, you can lock in a certain amount and then they pay that to you for the rest of your life. If you have any questions on this presentation, drop a line below and I'll answer it for you. See you in the next video. Until then, bye-bye.